Hi, this is Mike Maloney, and I just wanted to do an update on the health of the U.S. economy. Everybody knows that I've been expecting a recession to happen sometime within the next year or two. We are becoming overdue for a correction in our economy, and the recovery from the last recession has been quite weak. So where this one goes, I do not know, but I have a feeling it is not going to be good. And a couple of weeks ago, I was talking with a friend, and he's from New York, and he was telling me that the bottom has just absolutely fallen out of the luxury housing market there. The condominiums that are available for over $10 million, they've just completely stopped selling. And so I did a little bit of research and came up with a couple of articles here. In New York, a falling market for trophy homes in the sky. And it's these giant places that overlook Central Park and such and have these spectacular views. They've just stopped selling. Now, when bubbles pop, they often pop a little bit differently each time. Last time we saw the subprime market go first, and everybody was saying, oh, well, I'm in high end, so it won't affect me. All the realtors and stuff that I knew that were, or the architects that were doing the very high-end homes. They said, oh, the real estate bubble won't affect me. Well, guess what? They were out of work a year later. But New York City's Billionaires Row is dead, so this article says it all. I don't really need to go into any detail on this article, but it just says that it's dead. Then I took a look at, this is an article from M. Hansen Advisors, and they published the individual cities that the data that Robert Shiller comes up with. Dr. Robert Shiller, or Professor Robert Shiller of Yale University, compiles this data on all of the regional real estate bubbles, and he compiles it into a national average. And what you see here is that Atlanta has gotten close to their 2006 peak. Boston has surpassed the bubble of 2005. Dallas, the peak was in 2007, and look at where they are now. So they are way past there. And then we've got Denver, North Carolina. These are all slightly higher. Portland, Oregon, San Francisco, and Seattle. So we're back into these big bubbles. And how does this look on a national average? This is Robert Shiller's data. And so this is everything combined. And what he's showing is that we were in a hyper bubble back in 2007. And we've bounced back up into a severe bubble. It's not quite as big as the hyper bubble of 2007, but you have to look at the range of where home prices are fairly valued. And it's in this range here. And when you get out of it, you're in a bubble, and then there's a correction. And so you take all of this data on real estate reaching the end of this rebound, this bouncing back into a bubble, and then you add some other information to it that helps get a bigger picture. Big investors had a front row seat. This is drhousingbubble.com. But they stopped buying real estate in late 2014. So these are the big funds like Blackstone and so on. And now they're selling. Large investors are cashing out. So they're reducing the exposure in their funds, and they're offloading the real estate that they accumulated after the crisis of 2008, that they accumulated in 2009, 10, and 11. Now they're offloading that to the weaker hands, the small homeowner investor. And then you take that, and you also couple with that the fact that art sales are finally starting to tumble. High-end art has been something that has been a safe haven, a place that had returns for big investors, where they were looking for some place to stick their cash that wasn't bonds with almost no yield or even a negative yield. So the high-end art market is beginning to tumble. And then you take a look at corporate defaults reach 100, a 50% jump from this time last year. And what you see here is that the highest that it ever reached was 177 for this point in the year. That was back in 2009. So that was the defaults on bonds. That was caused by the crisis of 2008, at the end of 2008, causing a lot of companies to have to default on their bonds. And when you look at the information, 67 of the bond defaults are in the U.S. this time, where in 2015, for the same period, there was only 32 last year. So the number this is more than double that we're up to for this time of the year. And then you take that and you combine it with this Bloomberg article here that says the wealth bubble is in the graph is flashing a warning that it's in scary territory. And here is the graph. And what these economists, Daniel Thornton and Joe Carson, are saying is that each time household wealth, now you have to remember that household wealth is becoming more and more concentrated in fewer and fewer hands. There's some families that are becoming extremely rich, and then the average American family is not benefiting in this wealth curve, this chart. So, but what we see here is that the last few times that it's had a run-up, now this is household net worth as a percentage of their disposable income, so the income after taxes and so on. And it had a run-up in the late 90s, and then with the stock market crash, came back tumbling down and the subsequent recession, and then a run-up with the real estate bubble in 2006, 5 and 6, and then with the crisis of 08, did this big retrenchment. We've had a run-up again, and this is the highest peak of all. It's creating a little tiny head and shoulders top here. I find it interesting that this created a big head and shoulders top here before that crisis. And so this is also saying that we probably have some sort of recession coming up or something like that. And then, to top it all off, the Atlanta Fed just slashed its GDP outlook from 2.3% down to 1.8%. That is a big cut in the growth of the economy. And what that means is if the growth is slowing down, we're probably headed toward this recession that I've been predicting. I don't know exactly when it's going to come, but I know that it's not going to be pretty. Thank you very much for listening. If you got anything from this, please like it, share it, and subscribe to our channel. We'll see you next time. This video was brought to you by goldsilver.com. I'm proud to say we've been one of the most trusted dealers for over a decade now. We have fast, free shipping and a price match guarantee. While our competitors serve you ads, we serve you education. And that's the difference with goldsilver.com. To learn more, click the info button. Thanks.